First, we have Juhi Agarwal, founder and chief investment officer of the family office of Scan Holdings, here based in Delhi. She specializes in strategic wealth management and investment planning, managing a diverse portfolio with a primary focus on public debt, public equities, and derivatives. Her unique approach to portfolio management, leveraging an amalgamation of long-term fundamentals, technical analysis, and quant-based AI, consistently beats the Nifty by approximately 20.2% year over year. I'm looking forward to hearing about secret sauce. At Scan Holdings, she focuses on generating alpha while maintaining robust risk control. Welcome, Juhi. Next, we have Omkar Arora. Omkar, having worked with prominent promoters like the Om Kothari Group, Eraya Capital, and Krishvi Capital, he has been a keen learner and has had diversified experiences across debt, capital markets, and private equity. His learnings were fast-tracked when he was running a derivatives trading venture with the team between 2021 and 23. This is also when he got introduced to the principles of risk management. And life has obviously, as per him, never been the same for him since. So his expertise lies in designing streamlined, low-cost, expectation-optimized portfolios for family offices. The next speaker we have on the panel is Harsh Dhanuka. Harsh is the Chief Investment Officer at SAR Group Family Office, an accomplished financial services professional with deep expertise and leadership experience in the family office environment and in the investment management space. He leads the investment strategy and is responsible for setting up and managing the people, processes, policies, succession, and estate planning for the single office. Moderating this discussion, we have Bhautik Ambani. Bhautik is the CEO of Alpha Grep Investment Management and is responsible for driving business growth, strengthening and expanding the firm's domestic presence, and enhancing customer experience. Under his leadership, the company has launched Alpha Grep's maiden Alpha Mine Absolute Return Fund. He has over 18 years of industry experience, and prior to joining Alpha Grep, Bhautik was the executive director and a founding member of the team at Avendus Capital Public Market Alternate Strategies. He's also been associated with Ambit Capital, Kotak Wealth Management, and Mirae Asset in various capacities and positions of leadership. Bhautik, the discussion is over to you.
Thanks, Vanshika. It's always good to see Bloomberg. And for me, Vanshika is Bloomberg, so Bloomberg is Vanshika. So great, thanks. Thank you everyone for being here on this afternoon. I think Rishi and Pankaj have done a phenomenal job of getting all the intelligent engineering minds in the quant space together every quarter, which is brilliant. And I know this is the third forum, I think after Bombay, Bangalore, now Delhi. We have an interesting set of panelists here. 3 family offices are being represented here. All 3 of them have very diverse backgrounds, very diverse history of running family offices, and a very different approach of running family offices as well. And this is exactly what we're going to try and get from them in terms of how do they approach investments, and especially quant investments, in their own different ways, and how is that relevant for some of you all too. I think to start with, what we should think is, so what we've seen in the last few years is the number of family offices have gone up drastically, right? Like I think the last number that I've heard is some 300 plus family offices which are now set up as more institutional formats, which is phenomenally large. The capital which is now getting allocated, managed by these 300 family offices is also phenomenally large. So which means we're talking about very large pools of capital, and all of this is in the last few years, which means there is no long-term historical playbook in terms of this is exactly the right way of making investments, right? Now, considering that is the fact, most of these family offices get set up with an understanding that we want to preserve wealth, optimize for tax, obviously, which we obviously want to do in India. And the third thing is kind of building from a legacy point of view, right? Now, considering these are the 3 broad goals that one is trying to achieve, how do you kind of think of quant in this, keeping these 3 broad goals in mind, and where does quant kind of fit in, right? It sounds complicated. I think for most people, when you talk about quant, the first thing that comes to their mind is derivatives, leverage, something complicated, or maybe even black box, right? So maybe I'll start with you, Omkar, and then just go around the panel.
Yeah. Hello, everyone. So thank you for organizing this, everyone. So firstly,
Maybe start with your background, please, first, and then answer this question.
So I've been working with family offices for the last 5-6 years. It was this fact that they will grow to more than 300 in the next 5-6 years, which led me to this space, before which I was doing private banking. For a brief while, I was also doing, during the frenzy of things, I was also doing those option spreads and everything with some people and small caps trading. And eventually, I understood that the family office space is poised to grow, as liquidity events keep happening in India. And that is what led me to this space. And right now, I'm working with one of the family offices based out of Delhi, which is Ecos Mobility. Now, firstly, like she rightly mentioned that it's tough to decipher this space, because trust me, we are also trying to decipher a lot about family offices in itself, because every individual family out there is very different, and how you design their portfolios is like, it's a task altogether, because the expectation level is completely different. I've worked with families who are like completely doing mid caps, small caps value investing. I've worked with people who have, who do private equity and run them as try to run them as operating businesses. And then I am now working with people who have a clear statement that we don't want much equities in our portfolio. We don't want much volatility. Now, it's such a tough thing to make them understand that even debt can be volatile, and the drastic impact that debt can have on your returns is much, much more than equities can have. And that is what, and for the brief while, for the last 5-6 years, I've always been engaging with people with a clear motive that India is a very value fund manager country. And this will all change in the next 5-10 years. You just need that one phase of bad returns, and that will lead to that fact. Now, when I sit with families and when I talk family members and I talk to them and I try talking to them about portfolio volatility, to drive that point across becomes very tough right now, because things have been really great in the last 5-6 years for them. So volatility as a factor, they don't consider it as a serious issue, but thankfully in the last 7-8 months, they have started considering it as one. So when we design portfolios for families, we generally follow the format of an IPS, which is the policy statement. And within the policy statement, there are different allocations that we do to different asset classes. And a derivative of that policy statement is a product, product class statement. So basically, when we are trying to deploy it across assets in the IPS, there is a clear gap out there, which is I can do value. I can do value investing. I can do debt. I can do private equity. But if I talk about just public equities, where do I differentiate? In India, it's like, what next from, what is it apart from value? Sadly, it has been so difficult to take money out of India, which is a clear fact everyone knows. Thankfully, through Gift City, one can now, and thank you, Bautik, for that fund which you have launched, that it is still possible to take it out, right? And now we are, asking these questions that if we want to bring the portfolio volatility down and achieve mediocre returns, not great returns like 15-20%, that's what everyone has been talking about for the last 5-6 years. So how do we do it? And that's what we have been trying to explain to families, and that's where quant comes into the portfolio as something which gives me, which diversifies my portfolio, which does not give me much pain when markets go down, and which does not give me extravagant returns when markets go up as well. And to drive those points across promoters, and then explaining them the product classes and the product kind of products that we might be investing in, is a job that we are supposed to do for them, and that is how we are looking at quants right now in the portfolio.
Great, great. So Jui, over to you, your background, and then what do you think of?
Okay, hello everybody. I'm Juhi. I'm representing the Scan Holdings family office. We are a promoter-driven family office, and I am from the promoter family, so my perspective is going to be very different because we are very hands-on in the portfolio that we manage. We are a multi-asset fund, but we consider ourselves more like a hedge fund. The only difference being we manage our own money and we're not raising money from outside. But we follow the same set of parameters for investment policies, for risk management, for performance analysis, as any great fund manager would. And I say great because there's still a difference between a good and a great in terms of how they are able to, the kind of returns they're able to generate for their clients. So we see our own family as our client, and and that's how we structure our portfolio. Where, as far as family offices are concerned, I think traditionally we go back to the same point of risk, alpha generation versus preservation of wealth. I think family offices have always had this deeply ingrained in their minds, that they are okay with simple returns, basic returns, but they don't want to do something which can put their capital at any kind of risk. And for them, it truly has been seeing quantitative strategies or quantitative trading as something which is a very high risk, high reward setup. So they say, nahi, it's too good to be true, like, hame nahi chahiye. We are okay investing in gold, we are okay investing in private equity, we are okay investing in ETFs. पैसा बराबर रहना चाहिए, रिटर्न कम ज़्यादा से हमें इतना फ़र्क नहीं पड़ेगा, पैसा हमारा जितना है उतना तो रहना ही चाहिए, कल को बच्चे क्या खाएंगे, honestly that's the mindset people go with. So I think that's one key factor with which family offices have restrained themselves from investing in quantitative strategies. The second thing that we see as a trend is just simple lack of knowledge and understanding of the whole concept. Because family offices, for them, managing their money is not the primary business. Their primary business is to run the business which is there, which is their bread and butter. So they have never had somebody sit down and explain to them what exactly is it when we mean by quants, They just see it as some very heavy word with very heavy repercussions and hypotheses attached to it. And they feel we don't understand it, so we don't want to do it. So it's more a fear of unknown than the fear of risking their capital that prevents them again from becoming a participant. That has traditionally, I would say, stopped them from becoming a participant in this. And from, again, the influence from the West, that we have always heard big names like Jim Simons and Ray Dalio managing the hedge funds, and so they think that they are all big people who are financial experts. So only people who are financial experts have the capability, the resources, the access to actually do something like this. So they're like, nahi, simple log hain, simple kaam karte hain, and we have to keep things which are manageable for us. We don't want to go with the buzzwords, and let's not risk ourselves. But that this has been the tradition, but now more and more when we are meeting more families within our network, within India, and you said 300, I think that is the registered number. Honestly, I feel the number is a lot more than that. It's just not as organized and structured right now. So I see a lot of family offices getting more professional, and the two men sitting next to me are an example for it. That families are now becoming more professionally run. Family offices are now, they have higher involvement from the next generation. And that sort of change has brought about a change in the mindset and the thinking of the families as well. So now they are more welcoming to the idea of exploring new things, and they see quants as new, even though it has existed, I don't know, probably since 1988 or something. But they see quants as new space because it's a new area for them to be investing in. And so they now are open to having those kinds of discussions. They are open to exploring what it holds. They are open to understanding what it actually means to be investing in quant. So I think structural difference in the family office setup, involvement of next generation, professionalization of that setup has helped open their mindset and change the view in this regard. And also I think now, because there is some understanding, so there is also some demand. So there actually are now products available in the market for family offices to invest in or to start considering these things. The first step for any family office to try out anything is to invest a little amount with somebody, right? That's how they go. So they have started to take that small risk, and it's a blue ocean for both the fund managers and for the family offices to be exploring with each other, and I'm sure you would be experiencing this on an everyday basis. Today we are standing in terms of quantitative investing, where probably the mutual fund industry was 15 years back. You know, it's only the tip of the iceberg. So we have a very long way to go, but I only see good things happening in the coming future.
No, it's an interesting perspective. So we'll come back to some of the questions or some of the discussion points that you raised, where there is a certain perception versus what quant actually is. Whether quant is just going to be a fad which people are trying to tie today with small amounts, versus it actually becoming like a core allocation play at some point of time. So we'll come back to some of these aspects. Before that, Harsh, your perspective, please.
Hi, myself Harsh. I lead the family office for the SAR Group, the promoters of the Luminous brand. And we had set up this office almost a decade back, right? And as I hear from my co-panelist also, right? So family office as a space is evolving, right? And so is the risk-taking ability. So normally, when people perceive saying family office as a core goal of wealth preservation, that comes because people would have created that wealth by taking risk, right? So it's not like families are risk averse. They would have taken that risk, built that wealth, and now, and that risk continues to be taken on the business, as Joey mentioned. And therefore, this part is considered to be at least, more preserving the wealth piece. But so far so said, I think, family offices are evolving in different asset classes with their risk ability. So as far as, we are concerned, I think with respect to risk management is the core objective, right, with which asset allocations are being done, right? So whether it is on the conservative pool side, whether it is on the market pool side or in the growth pool side. And when it comes to quant, I would say, the way quant is a large subjective word, right? And as my co-panelists were mentioning, right, people consider it to be high risk, high reward, but quant could be as simple as investing in a simple factor, right? And especially when it comes to family office, allocation to quant strategies becomes important because they are more disciplined to that extent, right? Sometimes with respect to, even after having a IPS documented, right, end of the day, the money belongs to a patriot, right? And emotions come in between when you take decisions, right? So at least strategies like quant and all help you to kind of maintain a disciplined way of investing for certain part of the allocation while you are taking risky bets or alpha generating bets on the other side of the capital.
Thanks, Harsh. So I think let's start with I'll start with you, Joey, for a very, very simple, basic question. And considering the fact that you all invest in a very different way compared to most other family offices where they're allocating to external managers, to your family office, what is quant, right? Very simple.
So just to give a little background to what you said to the audience, is he says this because we are one of the rare family offices in India who, for the listed equity and derivatives part, we are doing it directly. So we have our own in-house research team, we have our own models and parameters on the basis of which we decide the call. So we are builders of the product for ourselves instead of allocators to fund houses outside. And also to add to this, to add to the first part that I said, we are professionally run. So we actually issue our daily NAV, and we are professionally driven to the extent that we issue our daily NAV, and it is published in the family office.
You put it up on Bloomberg?
Well, soon. Vanshika, something for you to add.
Something that we can benchmark with.
Yeah. So no, we are still ourselves benchmarking ourselves against other indices. But yeah, so the point is to say that we understand the importance of these parameters. So we try to incorporate them in our good practices. For us, quants it's really not an extension to investing. I think it's a very fundamental thing that we as investors need to understand. data is everything. Irrespective of whether it's not investing or anything at all, if anybody is in manufacturing business, if anybody is in services business, any sort of business it may be, if anybody is running an e-commerce business, data is fundamental to every single aspect of business, irrespective of the nature of business, right? How you use that data, you need data to, for your regular operating business, you need data to purchase better, you need data to sell better, you need data to operate better, you need data to run your production facilities better, you need data to hire people better, something as simple as that. Data is fundamental to it. So how is data a separate division for when it comes to investing? It's not. So you are simply using data to refine your decisions and make them better. So data at every step of investing, whether it be screening of stocks, analyzing of securities, anything, not just stocks, any security, any asset class, understanding where to invest, how to invest, what to invest in, when to invest in. Data is fundamental to all of these aspects. The only point when we are talking about investing in quant and how we see quant is using of that data to give yourself power to decide better. That's all. So we don't see quant as as something which is an arm added to it. We see it as a very integral part of investing in decision making. So for us, it's all wholesome and it's all one. It's not an extension or addition to what we are already doing.
Yeah, that's interesting. So basically, for you, it's a way of investing,
Yes,
right? Like for a fund manager, discretionary or fundamental is a way of investing. For you, it's a way of investment, right? It's not an allocation play saying that I'll do a certain percentage as quant and certain percentage something else.
In fact, when you say fundamental or technical, quant actually supports in that. So one can be a value investor, still use quant to value invest better. One can be a technical investor and still use quant to do it better. So you can use quant in whatever your investment style is. It's only to help you decide better, right? See things better, predict things better. So that's the whole point.
Interesting. Maybe, Omkar, why don't you give a perspective on the same thing as an allocator, right? Like in your view, how do you think of quant? Like what does quant mean to your family office?
Wow. That's how they see quants today. Because they're really excited about it. It's something which is very unique to them. And trust me, when you work with promoters, when they get excited about something, it means a lot. It becomes a club talks for them, right? And they are excited about it. The challenge, and this I'll tell you from example, the challenge why they are so apprehensive about things is, firstly, and this we spoke about earlier also, a lot of it has been missold. A lot of products out there have been missold in the past as quants, which is nothing but unko wo Excel mein filter karke, factors laga ke kuch kar diya, and they call it quants. And those have not done well, obviously, right? And this has happened like in the last 1 year, so many portfolios out there in family offices have just momentum funds. And there is a complete data bias out there. And then you go to the family, you approach the promoters, and then you tell them, see, it's not that there's something wrong with that factor. It's just that it's one factor that you invested in, and you didn't know the risks or the return capability they knew, but risks associated with it. And then in one of the meetings, I was asked, what do you do about it? And then I prepare a simple presentation. Now this is very novice work which mere level pe maine kiya, ki ek simple presentation, how if we combine a couple of factors, we can design a better portfolio. And then I also put in a disclaimer that there are people out there who can do much better work. And uske baad, I was obviously asked, who are those people? And I had no answer for it. Because I myself, having been on the lookout for the last many years, could not find such many credible people who are able to do it better than just simply doing 4 factors and investing across it. But yes, there is excitement out there. There is, as soon as earlier as yesterday, I was asked the question that, yari kaun sa algorithm kya hote hain? And I was like, listen, these are 2 very different things. And I'll sit some time with you, I'll do a meeting with you, and I'll explain you the difference between the 2. And then we will talk about how, and then I told him about the discussion I'm going to be a part of tomorrow. And it was all coincidental. It did not arrive out of it. It was derived out of it. Right? But yeah, there is excitement out there. And like Juhi you just mentioned, that we are ready to build a tail position and to just, start off things. But the thing is, we are still evaluating in our heads that how do we fit it in the portfolio, where do we fit it, and how does it mean something, and is it something which is scalable firstly? Because we can't build a tail position for the next 10 years and say, yeah, we will track this and see what happens 10 years later. No, we want to put in more money in the next 5 years so that we get some output out of all the efforts that we are putting in tracking it, right? So we are excited about it, we are keen about doing it, but the question is, are you guys going to put anything across the table which is valuable enough for us to put money in?
Interesting. So as far as I can see, there is a need for it. Obviously, how do you kind of offer that need, or offer solutions for that need is important. So Harsh, maybe my next question is to you. Quants is available in varied shapes and forms today, right from something as simple as factor products to certain complicated long-short funds to maybe even global long-short or derivative products, right? So all of this is available today in the market. In fact, beyond this, there are a lot of shops which are offering derivative strategies when they can run it in the client portfolios too. So today, as we can see, there are quants available in multiple ways and means. How do you as a family office kind of think about it, like A, what kind of strategies to allocate to, B, who do we allocate to, and C, then how much do we allocate, right?
So I think, as you said about quant being a larger kind of domain area, right, which covers risk-free to, completely conservative risk to moderate risk to aggressive risk strategies within quant itself. So the way we allocate is like, within the family office, in each of the pools, we would have a core allocation and a satellite tactical allocation, right? So as simple as factor-based investing or smart beta strategies becomes part of the core allocation, right? So sometimes it is like when you are allocating within investment to different managers of different styles, and as one of my co-panelists was mentioning with respect to momentum based, right? It's not like momentum based style is bad, but how much do you allocate and when do you allocate is important to that extent. So at least, because what happens is, as a family office, when you are allocators of capital, it is important to kind of allocate to diversified styles and not just for the sake of diversification, you allocate to 10 different managers. So quant at least helps you to maintain that disciplined styles of investing that you want to allocate to at all points of time or at different points of time. Because managers, although they say we are in this style, but with market changing or volatility, managers also change their styles during investment. But quant kind of at least helps you to maintain that allocation to that style of investment for your core allocation, which is more long term. When it comes to tactical, I think, funds like long short funds, which are more market neutral, right? Sometimes those allocations are done more tactically from a perspective to say that today I'm not clear whether I want to go overweight on equity to that extent, or I have created cash out of equity and I need to park it somewhere which is more market neutral to that extent. And therefore, all those long short funds for us falls in the tactical allocations, which are more, time bound to that extent, and you would park the surplus there. And when it comes to more derivative based sophisticated strategies, that is part of more alternate allocation rather than not disturbing the, core and satellite part of the portfolio, but as part of alternatives where, that part of alternatives has the guardrail to take a higher risk to that extent, right? I think one important thing when it comes to quant is to really understand the strategy well before deploying, right? Because most of the cases what happens is people look at the returns and then they go for that strategy, and the moment returns go for a toss, people exit it before giving it a complete tenure what it should be given, for that particular strategy to perform. So I think, as in our last discussion, people were talking about on education, right? So understanding the strategy, understanding the algos which is going behind, right? There's a lot of back testing of data that gets available with all the managers to that extent. So I think it's more conscious effort from the allocator side to understand that well before, taking a call in that deployment.
Thanks. Maybe you want to Omkar, take a stab at the same question in terms of, how do you kind of think of allocating to what kind of products and what kind of managers?
So when we do allocation to quant within our IPS, we generally look at it from two perspectives. See, firstly, the question that we ask ourselves is, what do we want to achieve? Do we want to achieve less volatility? Then, yeah, long short kar lete hain. International exposure mein long short kar lete hain. I'll give you an example why this is very important. China, as we all know, had not performed for a very long time, but there were good long short funds in China that were doing well for that time. So now when I look at international exposure and then I look at China and like, yes, it has done for the last 1 year very well, but maybe the next 10 years can be as bad as the last 10 years. So I need some diversification within China, some non-value diversification I need. And same thing I think about India. I ask myself, what if for the next 5 years India does not perform? Then that means as an asset allocator, I've done a bad job. There might be great stories, growth stories out there, but market is a completely different animal which we can never predict. So when we approach fund managers from that perspective and people who are looking to raise funds in this environment, the first thing that, of course, like he mentioned, we ask them is what are the kind of back tests that you can show us. And then we know that there are a lot of bias. There might be a lot of biases associated with back tests. Something as simple as a timeline, right? कि आपने कुछ ऐसा timeline मेरे को दिखा दिया. You've shown me some kind of timeline which has done well for your strategy, but it might not do well, in different timelines. So rolling returns and all that. And then we also ask them questions like, can you do some kind of Monte Carlo or some kind of stress testing for your portfolio and show me the results? And one of the things that I've lately started asking them is, can I come to you and see you do these backtests live in front of me so that in my head, see, technically they will not tell me everything that they do, that is for sure. And unlike a value investor, I don't have on-ground experience of 10 years to be able to prove to the management that this guy has done well in the last 10 years. There's no one out there who has been existing for the last 10 years and been doing it like full-fledgedly on a big capital. And for that matter, scale is also very important in these strategies. So these are the questions that generally I ask them, and I've started asking them, and I'm yet to come to a definite answer about the good ones out there, and so that we are able to build a tail out of them. So we are still in the exploratory phase, but we're geared to go, and we'll be ready to go in quite some time.
Sure, thanks. Juhi, my next question is to you, and maybe there are two parts to this which I want you to answer. So one is considering the fact that you guys invest on your own, right? So if there is another family office today which wants to do something like this on their own, and I meet a lot of family offices where they kind of keep debating on this question whether we should do this in-house, right? And what are the pros and cons, what are the challenges we may face? So maybe try and answer that part, for other family offices who may want to do this or are exploring that as an option. Two, when you are doing this for your own family office, then how have you kind of defined the objective, the method of investing, what is the approach that you take to investing, right? Because I'm sure you're kind of defining some of these things when you're doing this on a day-to-day basis.
Okay, so I'll take the first part first. I don't think everybody needs to do everything. Honestly, I think people should pick what fight they want to fight, and people should pick what skills they want to highlight. Everybody is skilled in a different area. I happen to be trained and educated in finance, so I chose that as my field, and I happen to be coming from a privileged background to run our own family office, so I chose that. But if that's not somebody's core area of work, you should focus on people who are skilled to do that. So everybody has different skill sets for that reason. It's good to want to do it yourself if you have the resources, if you have the understanding. Nothing is impossible to build. If you start to learn, of course, anybody from a different background, engineers are running financial industry, right? So nothing is impossible. Of course you can do it. But what are the stakes and what is the cost? That is one point. Second, if somebody absolutely wants to do it, I would say go to the basics. Like, we are very Marwadi in that respect. So we break down everything to the basic ABCs. The first time we picked a stock, we literally sat down and we read everything in the financial statements there was to know about the management, about the finances of the company. So much so we just knew that we had to understand the business model. That's how we function, right? And on basis of that, for our investing alone, we have 32 different parameters and systems of checks that our investments go through, right? So everything can be learned. If you sit down and you decide to learn it, I would say start from the basics. That's the first step that you cannot rule out. Quants is just an additional part of it. Quants comes as you learn the basics, but the basics, they never go out of the picture. So you have to start there. The second part of the question, where, how we are measuring it or how we are deciding for the objectives that we are investing it with. So we have a very clear mandate because we are a multi-asset portfolio, but of course, because we are directly investing in the listed space and derivatives, we are very focused on return generation with risk-adjusted returns. I would want to highlight that. Second, we are very focused on liquidity. So we only believe in being cash positive month on month. We absolutely are not okay with the idea that it's okay to hold investments for 8 years and 10 years in the name of high returns. We don't go by that ideology. So that is why when we are investing our money, we have 3 different kinds of allocations that we do. I'm sure a lot of strategies are also built around that idea. One is a long portfolio, a portfolio that are the bets that we don't, we just let our models decide. That when do we enter, when do we exit. We have, of course, whenever we are investing, whenever we have the signals from our models, we know a fair amount of time that we need to be invested in that security and what kind of returns we should be expecting from it. But then those are the portfolios that we don't change, irrespective of whether the market is going up or down. Then of course there are tactical buys, which we do for anywhere between 6 months to a year period, can be as short as 2 months as well, which is more driven by, of course the fundamentals always stay, but also technical calls. And then what we do as derivatives, which is on a month-to-month basis. So these are more actively trading calls. When we are using quants, we are not using that for this or this or this. We are just using quants to give us insights. Well, I can actually share 2 achievements that we have been able to accomplish in this space of quants as we are talking about. So we have been able to, when we started with this entire exercise of building quantitative in our portfolio, we actually had to, the first task was getting the right data. How do you get the data, where you get it for, how long you get it for, the quality of data. And we had the cleaning and what we were talking about before as well, the cleaning part, and how do you start to make sense of it. And then when we started to make sense of it, we saw the potential it had. So we had to choose which models we wanted to pick out from the entire spectrum. So we first went, as any conservative family office would, a long only portfolio. So we chose, okay, how can we intelligently make investments for a portfolio that we don't have to switch? So we have been able to now devise strategies which have been back tested and stress tested. So from a universe of 500 stocks, we have top 75, which are the highest yielding returns, which makes it very simple for us to invest whenever we have signals. Like if we have the fundamentals right, then it becomes very easy for us to invest in that. And that power just automatically gives us a clear view of the expectations to have year on year for the returns we are generating. So that's one thing. Second thing, I don't have my phone on me, but I would have showed you, we have developed our own Scan AI research lab, so which is an application for in-house team, where we have factored, where we have broken down every fundamental and technical factor of these 500 stock of universe into numbers. So taken emotions completely out of it, and we have changed the fundamental and the technical aspects to pure numbers, and developed all the 32 parameters that we invested on has been turned into a quants model, and our research lab gives us every single day real-time basis update on the position of the stock in terms of being investable or non-investable quantitatively. So we have been able to achieve these 2 feats for our investing space. But we are on to it next, and we are building now a model for derivatives trading. But I think all of these things they take probably 2-3 minutes to talk about, but months and years of hard work to build. And brain that goes into it. But yeah, so these two things we have been able to achieve. The objective stays simple as any family office. We are a family office at the end of the day. So our money is very dear to us, and it's the hard-earned money of the family. So capital preservation stays at the top of the game, but we don't want capital preservation to happen by missing out on alpha generation opportunities, because we see that there is great potential in the business, there is great potential in the markets, and we are very India focused. We are not global investors like most of our peer family offices. We stay very India focused, and we see huge potential in India in the coming years. And good days don't always last, especially in a country like India. So we want to make sure that we make the best of the times as long as they are going to be there. And the objective stays that you preserve the capital while also making sure that you get a big chunk of the alpha that can be captured. Yeah.
Very interesting. I think hopefully there are less number of family offices, which are doing what Juhi is doing, because then many of us here won't have, the jobs that we have today. I think what you're doing is like the chat GPT is doing to programmers today. So we don't want to be that space, but I think what you're doing is very, very interesting. So that brings me to the next question. And I think, I will probably want all three of you all to answer this. So for example, when most people are, when they look to allocate to, let's say, a PMS manager, right, traditionally, then a lot of times when I've spoken to people, the general perception is, let me find a boutique manager versus, let's say, a very large institutional format, because a boutique manager will potentially be able to generate, pick these interesting ideas, maybe generate better alpha compared to, let's say, a large institutional or a large PMS manager. So that's what I've generally heard from people, right, or from allocators or from investors. When you're thinking of quant, right, the same thing, if one has to choose between, let's say, a small, quant shop versus a more institutional format, which one would you choose? Large versus, let's say, a small quant shop with a few members there, and why? Right. So maybe Omkar, you want to take a stab at it first, and then.
If I speak from a promoter perspective, the money would most likely go to the institutional shop, because see, we're looking to allocate large pools of capital, and we need institutional oversight. We need data, proven on-ground data that these people have done well over the past. But the field in itself is so new that, we don't mind testing waters with the small shops as well, as long as we know the motivation, the grand plans of that small shop, right? If from an institution, we can't ever know what kind of strategies they are deploying, what kind of, we can't ask them deep questions because we'll never get answers from them. So we do expect from those small shops that they give us those answers, that we ask them that, what kind of strategies you're using, what if bad goes to worse in your case, because we know since they don't have that kind of operational excellence in their end, the probability of things going wrong is also high. And we're ready to take that risk. But then there comes also an interesting perspective, which I have, we have lately started asking these people is, firstly, see, many of them, the big ones the good ones out there, are not willing to open those small shops. And the motivation behind it is, out there are those tower researchers, those towers and gravitons and millenniums of the world quants of the world, who are, and you as well, by the way, who are offering these big pay packages to these people.
But we will answer your questions, don't worry.
No, you're very nice that way. But these people, the motivation behind, they are lacking that motivation, these small shops, these people who are willing to open these small shops. And it's these big companies that have kind of spoiled them in a way. They are getting what they deserve, but it does not open the entrepreneurial gates for them. Because it's very simple. See, in India, and India is a very cost-sensitive market, right? In India, if you have to make those kinds of pay packages, then you easily have to raise more than 100 crores of AUM. And it's very tough for a small shop to do that only on the basis of their name, because they don't have that kind of credibility in the market. So what we have started asking them is, hey, if you want to do this, then can we, not just as a part of, not just being an LP, can we become a GP with you as well? Can we back you in some way? What happens in that case is my upside becomes unlimited, because if that person does well And if I choose 10 such persons, and it's like just like private equity, if 5 of them do, or even 3 of them do well, then they will take care of the entire bad that will go, and bad will happen, right? So we've started offering them these kinds of solutions as well. And these are, trust me, motivations from the past that people back value fund managers and look at them, right? One of the people that I know, he backed the value fund managers when he had an AUM of just 15 crores. Today, that guy is managing 1,500 crores. And the money that he gave them as investments is still in the company, and it's also growing, compounding, right? So we're looking at it from that perspective as well, but still a blue ocean for even us. But we're offering those kinds of solutions to people, and let's see if someone ever takes it up or not.
Joey, your advice on it. When you know that there is a quant shop,
Yeah.
let's say there's a quant shop which, let's say, is specializing in quant. You could have a shop which is having, let's say, 5, 10, 15 members, and you can have a shop which is a larger format, but still quant. I'm not talking about institutions meaning HDFC, ICICI. I'm talking about still a quant shop, but maybe has, let's say, 300-400 member team, has diverse teams out there, including risk management, fund managers, all of that. So how would you choose between the two? That's the
Again,
question, yeah.
Because we are running ourselves in a very efficient way, I don't think big number of people ensures better quality of work. So I think our metrics are different in that respect. What really matters is how good a fit anybody's strategy is for your portfolio. It really doesn't matter whether they are big or small. You have to be sure of two things. One, why are you choosing a quantitative strategy for your portfolio? You have to be very clear about the objective of it and what part of allocation you want to do to the portfolio for that. Second is, why are you choosing the person that you are choosing, whether he is big or small? It may be you're a conservative investor. There can be, as he rightly mentioned, there can be conservative strategies also in quants, and there can be very aggressive strategies also in quant. You may like somebody's style of investing. You may like somebody's thought process of why, in what manner they are using quantitative mechanisms in building their strategies. That should be the criteria for choosing the manager or the fund. It has to be a good fit. Returns are a byproduct of skill and your confidence in somebody's ability to do well. If you're deciding to go even for a debt fund to go with a non-institution or an institution, the factors again remain the same. I'm telling you, like, go to the ABCs of everything. You choose a fund manager because you trust their capability and you know you have confidence in how they're going to be running the fund, right? You know they have the risk management systems in place. You know you will not lose the money. You know, okay, returns can be subdued at some points of time, but then when the returns are good, they can be good. So go with the fit, not with the size. It doesn't matter.
Interesting, yeah. Harsh, over to you.
No, I think continuing with what Juhi says, so one is strategy is important, right? So everybody is not running the same strategy, right? Whether that particular strategy fits into your overall allocation or not is important. And then, you know, there are some strategies which an institution can do a better, right? So a smart beta factor investing, right? ETFs are such cost optimized good products. You don't need to go to somebody's smaller shop, right? Versus, and when you say smaller, what is the definition of smaller? It's good fund manager with a lot of experience are opening those shops, right? So is it versus, you know, a large institution starting with less of experience in that sector or that domain to that extent? So for us, the experience of the person is important, right? Who is actually running the show to that extent. And it's not only the size to that, you know, of the shop that really matters, but at the same time, we have to understand that, you know, each one of us are playing a fiduciary role, right? Of managing someone else's money to that extent, and not only, you know, one generation, but multi-generation, right? Where you are answerable to. And therefore it becomes important that the risk management processes are in place. We have seen even smaller shops where experienced manager from large institutions setting up ensures that processes and risk management are important guardrails before, you know, kind of executing that strategy. Versus large institutions, we see in news every day, AMCs, you know, getting into issues of non-compliances, right? So therefore, the important is not about the shops, it is about the risk management processes which are well documented and actually executed in place. So therefore, when you're looking for these people, at least a history of some year to 3 years still matters, right? Because otherwise, till the time you don't have the proof of pudding, how do you believe on someone, right? So that is important, but in today's time, both are complementary to each other rather than saying that I want X versus Y to that.
No, I think very interesting perspective from all three of you also. Net, just to kind of summarize, what matters is fit of the right strategy, ultimately the pedigree of the people who are managing the money rather than, the institution which is doing it. And the third thing is, do they have the right risk management in place? So I think considering the time that we have on hand and, we have to leave some time for some question and answers from the audience here. Thank you so much, and we can open the floor for any questions that you all may have.
Hi. I just want a small answer, but I want that answer from everybody in the panel. Okay. When we say quant, broadly speaking, we talk about quantitative investing on one hand, on the other hand, quantitative trading. Since we're talking about family offices, let's take investing right now. Okay. I think major interest over here, and it's simplistic to understand that way. Now, when I say quant, I do agree with the fact, which was an underlying constant of everyone, that without a fundamental or technical analysis, helping you connect the dots of the variables involved, you cannot do much. However, quant investing can be seen in two ways, approached in two ways. I just want the ratio to which. One is quant for optimization, one is quant for signal generation, be it bond portfolio, equity, whatever, momentum, value, whatever. So give me one answer each. What is the ratio to which you use both? Is it all optimization, or is it 50-50% in terms of the efforts which are put? It could be a little subjective to quantify it that way, but still, I want the answer.
You said one was optimization. What is the other part?
Signal generation. Okay. It could be anything from connecting the interest rates to a principal component analysis to momentum factor, machine learning, anything. But those are specifically to get the signals to which assets to pick.
Sorry, just across, but signal generation is a part of optimization process, right? Because whenever you are generating signals on some basis which is helping you decide better, which is how the optimization is happening.
Okay, let me rephrase, I'm sorry. Optimization as in allocation, deploying the allocation.
So I think what is, if I'm getting it correctly, I think his question is that at one level you have alphas, and those alphas kind of give you the signal in terms of what to pick, not to pick. And the second part of it is in terms of allocation, right? Because what the optimizer will ideally land up doing is over a period of time, which alphas to pick and which alphas, if you're picking, then what kind of weightage to give them is what the optimizer would ideally land up doing, right? As two legs of a quant model. So I think his question is, what kind of weightage do you give one versus the other? Is that correct?
Yes. Because largely speaking, we have seen historically that allocation has mattered a lot more than even stock picking when it comes to portfolio management. So on that note.
Okay, so I can talk about myself. How we do it is, we give equal weightage to both. The model that we have developed gives us, that's how also we size our positions, is we have a fair idea of how long we are going to be invested in a stock and what kind of returns should we be expecting. So when we are entering a trade based on a signal which is given to us, on the basis of the potential returns and the time period of holding, we decide the allocation of it. That part, the second part, I have to be honest, is not automated for us yet. We are in the process to do that. Hopefully we will be able to. We're still in works for that. The first part, signal generation, is all quant based and optimized for us. The second part, the allocation, is still being done with human intelligence and based on the results that the quantitative model gives us.
Thank you. Anyone else?
So for us, the way we look at it is we don't have an in-house model that we run in such a manner to that extent. For us, we use quant strategies more as complementing strategies in the portfolio to that extent, right? To do a particular allocation to a particular style of investment, right? And therefore, within the IPS, I need to have a certain diversified style of investing, and hence I would use that particular strategy in the portfolio that would complement to the other part of the portfolio in terms of risk minimization and optimized return on the overall basis.
So I think it'll be similar for you, Omkar. Maybe you can take the next question, please.
Okay, just a quick one. So I have an experience of running a couple of international family offices historically. So it's a tricky question. Generally, your portfolio, so it runs into how many spreadsheets? But generally, I've seen to family offices, irrespective of the size, इस वाले को $500,000 से ज़्यादा नहीं देना है किसी को भी. So I was running a $700 million fund and I had like 240 instruments to track. So are you guys doing the similar things, or is it like, it just goes as a percentage allocation?
We do it very simply because we are passive allocators. So we have only 2 sheets.
Okay.
2 sheets, maximum 15, 20 line items. What matters for us is how the entire total portfolio approach, basically, how the entire portfolio is doing. And we don't, like I was telling about it earlier today, we look at specific fund managers' performance like once a quarter. And we generally don't consider looking at the stock performance per se, because we trust someone when we give them money and we trust them to do their duty well. And that's why historical track records matter a lot to us.
I don't think in India they will be able to run into multiple sheets, because in that case you would have allocated to the entire industry.
Yeah, correct.
And also, I think conviction is very important when you are investing with somebody or for yourself also. If you are diversified to this extent that nothing holds meaning, then I don't know where the returns are coming from, because at the end of the day, you have to have conviction for where your money is going. That's how you are able to generate alpha. Otherwise, I think you can be allocating.
Talking about over diversification, yeah.
No, but as an anecdote, I would say, even though the schemes may not run into multiple sheets, but if you break the schemes and look at the stocks, right, for most of the family offices, they would end up holding a larger market, right? And that is the real problem, is the diversification happening in the right way, or you are ending up diversifying between schemes and then holding the entire market per se?
No, for that matter, one of the first jobs that I've ever done working with any family office out there is cleaning of the portfolio in the beginning. Because everyone ends up holding the NSE 500 in a different way.
I think there was a question at the back. He's been
Yeah.
raising his hand for very long.
Thanks for spotting.
Hi, I have 2 questions. One is for a new trading partner, how much time do you take to validate their strategy once you start? And another is for a new asset class like digital assets, what's your approach to it?
So we do look at them like, for 3 to 6 months, we, start with a small tail position and then judge them for the next 3 to 6 months about, how the performance has been. And that's what I've been doing with Bhautik, with his international fund as well. Right? We give them some time to perform and then we, decide that if we want to go all in into it or not. And I'm sorry, I forgot the second part of your question.
Digital assets.
Yeah,
Are you
very
looking at
nascent. I mean, I have been trying my best to push people into it, and particularly Bitcoin only, because to be very honest, it has been only 2 years since I understood Bitcoin. So yeah, trying my best, but the Bitcoin itself has gone up so much that even I am scared to pitch it now. But yeah, we are trying our best to be, to at least give some allocation to it. What I tell them is, simply if we are able to put in 0.2 or 0.3% of our assets every year and build a portfolio over the next 5-7 years, then we won't mind if that portfolio even does not do well in the long run, because it would the money would have gone out of our profit cushion. So that's how I'm trying to explain it and position it to them right now, and let's see how the success goes.
Great, thank you. I think the board here is telling us to exit, so thank you so much, everyone.
Thank you so much. A very, very loud round of applause for the team. I think the panel's been beyond candid. It's something that everyone does look forward to when you're having a discussion. Could I please request Mr. Sunil Ramrakhani to come and felicitate the panel on our behalf? Thank you.